Hi, hello friends, welcome everyone to Precision Price Action Pro Trader series. Today we have a very interesting topic. What is important for a trader? What is very important for a stock trader? Is it the target or the stop loss? Is it the risk or the reward? A seasoned trader will always focus on one important thing, that is risk management. Returns are secondary, risk is mandatory, target is secondary, stop loss is mandatory. In this interesting series, we are going to learn about the science of putting stop loss. Come over, let's deep dive. So friends, what is a zone? Why zones are important? In the previous videos, we have learnt about different kinds of zones. Zones are actionable areas. They are the places where there is maximum acceptance of the price. Zones are the places where there is a transaction that is happening. It is a region where there is tug of war between buyers and sellers. Every zone, be it a rally based rally, drop based rally, drop based drop and rally based drop, need not be a tradable zone. It can just be another ordinary zone. While we will look for very specific patterns which will help you to make stronger trading decisions, because you want a very high RR. We don't trade anything less than 1:3 in positional trading. If it is intraday, I don't trade anything less than 1:2. There are very rare cases where I even go to 1:1.5. That is only in an algo world where everything is automated. We have an absolute visibility on what is the kind of risk that is going to happen in the last 3 years, 5 years, 10 years also. Alright. So, zones are places where there is very high probable trades. And finally, remember, we are retracement traders, we are not breakout traders, we are not support resistance traders. I always tell people, we are not cheetah, we are tigers. A cheetah will run behind the deer, whereas a tiger, it will wait for its prey at the riverbed. Can you guys imagine? Can you visualize? It will go to the riverbed, wait for its prey to come, wait for its prey to drink water in a very vulnerable position. Maybe it will twist its legs to drink water, maybe its attention levels are very low. That is when the tiger jumps. That is what we officially do in price action trading particularly, that is retracement trading. Alright, so now there are two unique kinds of zone marking. Your zone marking is very critical. Why it is critical? It defines your stop loss. Why stop loss is critical? Because it defines your risk. If you don't put a right stop loss, there is high probability of losing your trade. How many times you have fought with people? I had put a stop loss, the price came, kissed my stop loss and left. Does it mean somebody was watching your trade? Or are you that big that people have to track what you are doing when you are trading 1 lot, 2 lot, 5 lot, 10 lots? Market is very big. It's huge. Even the biggest of the institutions will look small when you take the whole broader market. Let's get into the crux of the story. One of the very crucial aspect in price action trading is zone marking. There are two kinds of zone marking. One is your aggressive entry zone marking, also called as wick to wick zone marking, where your risk is very high. However, there is every possibility of getting a trade. The second one is body to wick zone marking, which is called as a conservative entry. Risk is comparatively lesser, much lesser than the aggressive wick to wick story. However, there is a high probability of not getting a trade. If you personally ask me which is the better way of trading, I believe the best trading method is this, body to wick. Why? Because I don't care if the trade doesn't come, because tomorrow I will get a trade. However, in this model I am going to reduce something very important. Risk is less. Clear? Sounds good? Now let us quickly jump into these concepts one by one. So what kind of a scenario is this, friends? As we have already discussed, we never ever trade. We will never trade zones, never trade RBD, DBR, DBD and RBR. We will never trade them, but we will identify some special patterns called as power patterns. However, using these patterns we will identify and learn how to mark the zones. Very important lesson. Now, is this a strong drop, a beautiful base and a beautiful rally? What kind of a structure is this? It is a reversal structure. And what kind of a structure is this? It is a bullish structure. Correct? It is a reversal structure and a bullish structure. How do we mark it? One of the simplest way of marking is to mark from wick to wick. Now let me ask a basic question. Where do you find maximum transaction? Is it at this candle? Is it at this candle or is it at this candle? I have told so many times, your momentum candle is like a highway. There is no disturbance. You are driving at a very high speed, super velocity. While your base candle is like a junction, is like a toll booth. It's like a traffic signal where there is lot of crisscrossing between the people. So the maximum transaction that always happens is at the base candle. That is the region where the buyers and sellers accept the price and do a transaction. That is why it is a base, because there are two people fighting. Here nobody is fighting. This is sellers under control. This is buyers under control. Nobody is fighting here. Whereas here both buyers and sellers are fighting. Now the process of marking wick to wick is very simple. Take that base candle, take the bottom of that base, draw a straight line. Take the top of the base, draw another straight line. That is your zone. Suppose you wanted to trade here. Okay, that is how you need to mark your zones. This is called as your proximal line. This is this is called as your distal line. This is called as your proximal line. Maybe if you take an entry here, your stop loss is here. All right. Now, you are a retracement trader, right? So what happens if you have this as the level? Your price will typically come here, take an entry, this is your entry, this is your stop loss, and you expect the price to go up. Sounds good? That is what happens here. Take the top of the base candle, take the bottom of the base candle, which is called as the distal line, the top is called as the proximal line. What is proximal? Something that is proximal to the close price. What is distal? Something that is very far away from the close price. So this is very proximal to the close price, this is very distal to the close price. And when price comes there, we expect the price to react. The whole purpose of this video is to explain you how to mark the zones. Alright, don't think of trading all these RBDs and DBR. That is the most amateur way of trading price action. If you trade an RBD, that means you are making a decision based on one ball performance in a cricket match. India is fighting maybe Namibia, and in 1 over India achieved hardly 2 runs out of 6 balls, and you will declare that India is not performing well. Maybe in the previous over they have earned about 25 runs. Alright, so that is not the game you need to play. Now look at how the marking goes with respect to supply. Take the top of the base, take the bottom of the base, whichever is closer to the close price. This is a close price, right? LTP, last traded price. What is close to this? This is the one. So this is your PL, this is your DL, proximal line, distal line. And when by any chance price comes to that level, you expect the price to react. This is the way you mark your zones. This is the concept of wick to wick marking, where you take the top of the wick. So many times we talk about bases, right? What is a good base? How many times we have discussed? Imagine instead of this base, this line is like this. Okay, let us say like this. What will happen? See, this is your distal line, this is your proximal line. What is the R now? The risk, so big. But when your base is small, your R becomes so small. Which is the better R for you? So what kind of a base is important? A smaller base is important. Make sense? So that is the crux of the whole story of wick to wick marking. Look at that, bottom of the base, that is the proximal line, top of the base, that is the distal line. When price goes there, we expect a strong reaction. Alright, with this we successfully come to the end of the video. You have learnt how to mark a zone from a wick to wick model perspective. In the subsequent videos, I am going to explain you how body to wick marking works. Thank you very much.
Are you tired of stock market losses? Tired of hundreds of boring indicators and the frequent drawdowns? Do you want to understand how to trade markets without indicators? How institutions cheating the retail traders, and how to make fair and consistent trading methods? The answer is IT3T Mega Webinar, India's most comprehensive and 100% money back guarantee training program for stock market investing and trading. And what do you learn from this webinar? Techno fundamental investing, WD GAN techniques, precision price action trading, the option trading strategies, algo trading, and also trading psychologies. So it is a package of 200 world-class investing and trading books jam-packed into the 12 days of webinar. And what you can expect from IT3T: genuine training program with examples and assignments, no indicators, real-life examples, proven and reliable methods. And what you shouldn't be expecting is holy grail formulas, zero loss strategies, 90% win rate stories, get quick rich Ponzi schemes. And we also have students across the globe. The three things IT3T always promises is 100% money back guarantee program, 100% brokerage credit, 100% lifetime learning. But that's not it. We have an early bird offer for you at just 35,000 rupees for first 25 students. So how do you enroll the IT3T program? Simple. Just log on to www.i3t3.in or contact our webinar manager